one simple direct question. There is a grade A office building in Bangalore's Manyata Tech Park. JP Morgan has its office there, and Goldman Sachs sits there. Infosys, Accenture, all of them. The estimated value of that building approximately 800 crore. Now you are probably thinking that's only for billionaires. But I'm telling you today, you can become a co-owner of that exact building with that with just like rupees 300. No bank loan, no broker, no registration, no stamp duty, just a phone, a demat account, and rupees 300. This is no magic. This is called a REIT, Real Estate Investment Trust. In today's video, I'm going to give you everything you need to know about REITs, the kind of complete, honest guide with that most financial advisors don't give you for free. What is it? How it works? How much return you get? What taxes apply? Which are the best REITs in India? How to buy? How to sell? Watch this video till end. Don't miss a single thing. Okay, so let's start with something relatable. Most of you have probably thought at some point, I want to invest in real estate. I want rental income. I want to put money into property. But what's the problem with real estate? I would say that to you. So we'll see that problem one um, will be like price. So a 2 BHK flat in Bangalore starts at 60 to 70 lakh. Commercial property 2 to 5 crore minimum. And problem 2 is loan. You need a bank loan EMI burden for next 20 years. And next problem 3 is tenant management. Finding tenants, collecting rent, handling maintenance, legal disputes, a complete headache. Problem 4 is zero liquidity. Need your money back urgently? Selling property can take 6 months to a year, sometimes longer. So, you want real estate exposure but without all these problems, that's exactly where REIT comes in. A real estate investment trust is an investment vehicle that lets you become a co-owner of massive commercial properties without directly spending crores simply through a trading app on your phone. It is regulated by SEBI. It is that is SEBI, and it is listed on NSE and BSE, and it distributes rent to you every single quarter directly into your bank account. Today, India has 5 listed REITs. India's REIT market has already crossed approximately $18 billion by 2025 and is projected to reach rupees 2 lakh crore by 2030. The investors who understand REITs today will be the one benefiting the most tomorrow. So let's start from the absolute zero. REIT. So what is a REIT? The easiest way to understand a REIT is to think of it like a mutual fund, but for real estate. Just like a mutual fund, manager takes your money and buys company stocks. A REIT manager takes your money and buys commercial properties. And then the rental income from those properties is distributed back to you, the investors. By Indian law, a REIT is required to distribute at least 90% of its taxable income to investors. This is not optional. This is SEBI's regulation. It is the law. And how a REIT works is um, I'll be saying you how a REIT works. So the REIT company, step one, we'll understand it step by step. Step one is the REIT company buys multiple large commercial properties, office parks, malls, warehouses, etc. Step two, this REIT company gets listed on a stock exchange, NSE or a BSE. Step 3, you and thousands of other investors buy units. Just like buying a stock, 1 unit, 10 units, 1000 units, whatever you want. Step 4, large companies. like IT firms, MNCs, retail brands become tenants and pay monthly rent. Step 5. The rent is collected by the REIT and distributed to investors every quarter. Step 6. As the property value increases over time, so does the REIT unit price. You earn capital appreciation on top of the regular income. Simple real world analogy. If I want to say, like how a REIT is, in simple step, imagine a building with 100 floors. None of us can afford to buy the whole building alone. So 10,000 people pool their money together and buy it jointly. Every month the building earns rent from tenants. That rent is split equally among 10,000 co-owners. That is exactly what a REIT does. So when did REITs come to India? Is SEBI introduced the REIT regulations in 2014. India's first REIT is Embassy Office Parks, was listed in April 2019. Since then, the market has been steadily growing, and as of 2026, there are 5 listed REITs in India. Now, let us come to types of REITs. So, um, not all REITs are the same. Let's understand the different types. Type 1 is office REITs, that is most common in India. These REITs own commercial office buildings, IT parks, and business campuses. Example, Embassy Tech Village in Bangalore, Mindspace Madhapur in Hyderabad. The tenants are TCS, Wipro, Google, Microsoft, JP Morgan, and India has 3 major REITs in this category. Type 2 are the retail REITs, that is shopping malls. These REITs own and operate premium shopping malls in India. Only one retail REIT is currently listed, Nexus Select Trust. It owns 17 premium malls across Delhi, Mumbai, Bangalore, Hyderabad, Pune, and Ahmedabad. Tenants are Zara, H&M, PVR, Starbucks, McDonald's, Reliance Retail. And type 3 are the warehouse or industrial REITs. These REITs own logistic parks, warehouses, and distribution center, centers, um, growing rapidly due to the Indian e-commerce explosion. No separate direct listed warehouse REIT in India yet, but it's coming. But so these warehouse or industrial REITs are not yet in India, but they are coming. Type 4 are data center REITs. They own server farms and data infrastructure, one of the fastest growing categories globally thanks to AI and cold, cloud computing. And Mindspace has already started adding data center assets to its portfolio. Type 5 is residential REITs, own large housing complexes and apartments, very popular in the USA, not yet available in India in listed format. Quick summary for Indian investors is right now in India, you can invest in office REITs and one retail REIT, and that's actually a great starting point. India's IT and consumption boom directly benefits these sectors. Now comes the most important question is to how much do you need to invest. So this is the answer that surprises most people. Earlier REITs had a minimum lot size of 200 or 500 units, meaning you need 60,000 to 1 lakh just to get started. SEBI changed the rules. The minimum market lot is now just 1 unit. Here are approximate per unit prices for all 5 listed Indian REITs in 2026. So, Embassy Office Parks, the approximate price per unit is 310 to 370 rupees. Mindspace Business Parks is approximately 310 to 360. Brookfield Indian REIT is 230 to 280. Nexus Select Trust is 120 to 145. And Knowledge Realty Trust is 100 to 130 at its minimum. So that means like you can literally start your real estate investment journey from rupees 120, like, and with 5,000 you can buy 35 to 40 units of Nexus Select Trust. With 10,000 you can get 28 to 32 units of Mindspace. And there is no dedicated SIP option for REITs directly, but you can invest a fixed amount every month by manually buying units. Many investors call this a manual SIP approach, and it works very well. Recommended starting point is to begin with 5,000 to 10,000, understand how it works, then gradually increase. Then we have how much return can you earn. So now the most important part, how much money will you actually make. A REIT return comes from two sources. Return source one is distribution or dividend income. Every quarter, once every 3 months, a distribution is credited directly to your bank account. In India, the current annualized distribution yield from REITs is approximately 6% to 8% per year. So, real calculation example, if amount invested is 1 lakh, yield is 7%, annual income will be 7,000, and quarterly payout will be 1,750 for every 3 months directly in your bank account. This is passive income. No work, no calls, no tenant drama. Just invest and receive. Let's compare this to other options. So in if you compare it to bank FDs will have an annual income or yield of 6.5 to 7% with no capital growth. Savings account will have 3 to 4% annual income, and residential rental will be 2 to 3% of property value. Gold will be 0% and no regular income. REITs have 6 to 8% income plus capital growth is equal to double benefit. And return source 2 is a capital appreciation. So, as the underlying real estate properties increase in value over time, the REIT unit price also goes up. Historical performance is saying Mindspace REIT listed August 2020, 5-year total return over 52%. CAGR is approximately 8.85%, and lowest standard deviation is more stable and risk adjusted returns among all Indian office REITs. So, Embassy REIT is India's first and largest REIT, listed April 2019, consistent distributions every quarter since listing, and heavy institutional holdings, FIIs, mutual funds, insurance companies, all invested. Morgan Stanley in 2026 upgraded Mindspace to overweight, project 20.5% returns for financial year 27, and this is a massive institutional vote of confidence. Realistic return expectations and honest table. So if you see a realistic way of expectations and honest table, the scenario is conversive. It is conservative. So conservative in the sense dividend yield will be 6%, capital gain will be 3 to 4%, and total annual return will be 9 to 10%. And moderate, so and there will be moderate, if you take it as moderate, then dividend yield will be 7%, capital gain will be 5 to 6%, and total annual return will be 12 to 13%. And if you take it as optimistic scenario, it will dividend yield will be 8%, capital gain will be 10 to 12%, and total annual return will be 18 to 20%. So important honest disclaimer here is that this is based on past performance and future returns are never guaranteed. REIT units prices go up and down with the market. Only invest money you can keep locked away for at least 3 to 5 years. And If you see the compounding power example, like invest 1 lakh in REIT, in REITs, assume 12% total annual return, moderate scenario. Reinvest every quarterly distribution into more units. Say suppose year 1 you have invested 1 lakh 12,000. Year 3 it will be 1 lakh 40,493. Year 5 1 lakh 76,234. And year 10 it will be like 3 lakh 10,585. So just 1 lakh growing into 3.1 lakh in 10 years without any active effort. That is power of compounding when the income gets reinvested. Let's now go into the India's biggest REITs detailed profiles. So let's now deep dive into each of India's 5 listed REITs one by one. REIT 1 is the Embassy Office Parks REIT, ticker Embassy, which is listed April 2019. So it is backed by Embassy Group plus Blackstone, USA's largest real estate private equity firm, and the properties are India's largest REIT by assets. Grade A office parks in Bangalore, Mumbai, Pune, and Noida, Embassy Tech Village, Embassy Manyata Business Park, and Embassy Tech Zone, iconic campuses. The tenants being Google, IBM, JP Morgan, Cognizant, WeWork, world class multinational companies. Over 200 tenants and extremely well diverse. Occupancy is consistently 88 to 92%, and distribution yield is up to 6.5% to 7% per year. Best for conservative beginners who want maximum stability, and India's most liquid REIT, easiest to buy and sell. Risk level is low to moderate. Next, let us go to second REIT, that is the Mindspace REIT profile. Um, so Mindspace Business Parks REIT, ticker is from Mindspace, listed August 2020, backed by K. Raheja Corp plus Blackstone. Properties are Mumbai, Hyderabad, Pune, and Chennai. Mindspace Airoli, Mumbai. Mindspace Madhapur, Hyderabad. Premium IT companies with world class infrastructure. Tenants being Microsoft, Qualcomm, Meta, Facebook, Amazon, Accenture, Barclays, and Fortune 500 companies as tenants. Risk of tenant Risk of rent default is almost negligible, and 5-year performance total return being 52% plus CAGR 8.85%, lowest volatility among all Indian office REITs, consistent steady growth. Morgan Stanley rating um, overweight in 2026, Morgan Stanley's top REIT pick for India, and distribution yield being 6% to 7% per year. Best for growth oriented investors who want stability alongside capital appreciation. Analyst community's first choice, and risk level is low to moderate. Next, we have REIT 3, that is um, moving to REIT 3, that is Brookfield REIT. So Brookfield India Real Estate Trust is ticker being BIRET, listed in February 2021, backed by Brookfield Asset Management, Canada's world's largest alternative asset manager, 100% institutional management, global real estate expertise brought to India. Properties being Gurugram, um, Properties being Mumbai, Gurugram, Noida, and Kolkata. Candor Tech Space Office Parks, large format commercial campuses. Occupancy improved to 92% committed as of December 2025. Strong recovery trajectory, and distribution yield being up to 7 to 8% per year, highest among Indian office REITs. Best for investors who want the highest yield and trust in Brookfield's global brand and track record. Slightly higher yield comes with slightly more growth stage risk. the risk level will be moderate over here. Next, coming to the fourth one, that is Nexus Select Trust, ticker being NXST, listed May 2023. The type is India's only listed retail REIT. It's for shopping malls. So properties being 17 premium shopping malls across India: Phoenix Market City, Pune, Mumbai, Bangalore, Nexus Center, Ahmedabad, and several others. Total gross leasable area across India's most visited malls. Tenants being Zara, H&M, Starbucks, PVR Cinemas, McDonald's, Reliance Retail Brands, Apple resellers. Occupancy being 95 to 97%, India's premium malls are essentially running at full capacity. Post COVID recovery has been remarkable. Mall football is at all time highs. Distribution yield being 6% to 7.5% per year. Best for investors who are bullish on India's consumption story. India's expanding middle class and aspiring young population love premium malls, and this trend will only strengthen. Risk level is moderate because retail sector specific risk and consumption risk, not work from home risk. Coming to fifth, that is Knowledge Reality Trust, ticker by KRT, listed 2025. This is the newest. Focus being office and knowledge economy, real estate assets. Status brand new player, still building its performance track record. Best for risk tolerant investors looking for early entry into a newer, potentially high growth player. And risk level is moderate high because less historical data available. If we come to master comparison table of all these REITs, we can see Embassy being 6.5, Embassy has been 6.5 to 7% yield, backed by Blackstone, and best for beginners or stability, and risk also being low to moderate. Mindspace being 6 to 7% and backed by Blackstone again, best for growth plus stability, low to moderate risk. Brookfield being 7 to 8% yield, uh, backed by Brookfield Dam, best for highest yield, and risk is also high, like moderate. And Nexus Select has 6 to 7.5% yield, backed by Blackstone, best for Indian consumption play, risk is moderate, and KRT is to be decided because and we don't know what it is backed by too, and it is best for aggressive entry, and risk is moderate to high. So my personal recommendations is, if you are a beginner, start with Embassy or Mindspace because most liquid, most researched, most stable one. Want to diversify, spread across Embassy plus Mindspace plus Nexus. Want highest income, add Brookfield for its superior yield. Now, let us come to the advantages, like why invest in REITs. So let me give you a real advantages, not marketing fluff. Advantage one is quarterly passive income. Every 3 months, rent distribution lands directly in your bank account, and zero work, zero effort, a genuine second income stream alongside your salary. Advantage 2 is access to grade A commercial real estate. Co-owner of an 800 crore building from just rupees 300. um, Properties that you could never afford to own individually are now accessible to everyone. Advantage 3 is complete liquidity. Physical property takes 6 months to sell, whereas REIT units sold in 5 seconds on NSE or BSE. T plus 1 settlement, money in your bank account the very next business day. Advantage 4 is SEBI regulated and full transparency. That is mandatory quarterly reports, occupancy data publicly available, audited financials every quarter, no builder scams, no registry fraud, no opacity. Advantage 5 is built in diversification. One REIT gives you exposure to 20 to 30 properties, 200 plus tenants, multiple cities. If one tenant leaves, 199 other are still paying rent. And advantage 6 is world class professional management. So management being Blackstone, Brookfield, the world's best real estate asset managers run these REITs. They handle property acquisition, tenant management, maintenance, and leasing. And you invent, they work, you earn. And advantage 7 being that inflation protection built in. Commercial leases in India have annual escalation clauses, typically 3 to 5% per year. Your rental income automatically grows with inflation, unlike an FD that gets eroded. Advantage 8 is to no stamp duty, no registration, no hidden costs. Direct real estate, 5 to 7% stamp duty plus registration plus broker commission. And REIT is standard stock trading brokerage. That's it, nothing else. Advantage 9 is portfolio diversification. Equity plus debt plus real estate plus gold. That is truly balanced portfolio. Adding REITs reduces your overall portfolio volatility. And if we are talking about the um, advantages, we need to also talk about the disadvantages of uh, like or disadvantages and limitations of a REIT. So I will be completely honest with you. REITs are not perfect. Limitation one being not as high returns as pure equity. No, Nifty 50 has historically delivered 15 to 18% CAGR over long periods. REITs typically deliver 10 to 13% total returns. If capital growth is your only goal, direct equity might suit you better. Limitation 2 being distribution income intaxable. Unlike equity long term capital gains, which have 1.25 lakh exemption, REIT distributions are taxed at different rates depending on components. Complex explained in detail in tax section. Um, like limitation 3 being market price fluctuations, that REIT unit prices go up and down with the market. If the RBI hikes rates tomorrow, REIT units prices will likely fall. These are not fixed deposits with guaranteed returns. Limitation 4 being interest rate sensitivity. When interest rate rise, REIT valuations fall. Two reasons being borrowing becomes expensive for REITs, and second is their yield looks less attractive compared to higher FD rates. Limitation 5 being very limited options in India. The USA has 200 plus REITs, residential, healthcare, hotel, industrial, data centers, everything. India has just 5, mostly office plus retail. Sectors diversity is limited. Limitation 6 is no control over investment decisions. You cannot decide which properties the REIT buys or sells. If management makes a poor acquisition, you bear the impact. Limitation 7 being office concentration risk. Three of India's four major REITs are heavily weighted toward IT office parks. If India's IT sector slows down or work from home becomes truly permanent, occupancy and income could be affected. Let us now go to the risks of investing in this. So, risks like how safe are REITs? So, let's address risk directly and honestly. So, overall risk rating is low to medium. Risk 1 being vacancy risk, that is medium. If tenants give up office space, rental income drops. Mitigation is long term 5 to 10 years leases plus 200 plus diverse tenants. If even if one major tenant leaves, the rest continue paying. Risk 2 is interest rate risk, which is also medium because rising RBI rates is to REIT unit prices fall. Good news that India is currently in a rate cutting cycle. from 25 to 26, which is actually the best environment for REIT investments. And risk 3 is economic slowdown risk, that is low to medium. So a recession causes companies to reduce office space, REIT income falls. Current reality is India's GDP growth is at 6 to 7%, and economic risk is low right now. Risk 4 is regulatory risk, which is also low because SEBI or government changes tax rules. Post tax returns affected. Good news is that Budget 2025 actually improved REIT taxation. LTCG rate became more favorable. And risk 5 is that work from home risk. Low to medium, but post COVID, permanent work from home was feared to destroy office REITs. Reality check is that India's major IT companies have all returned to office first policies. And Embassy and Mindspace maintain 88 to 92% occupancy. That's proof offices are very much in demand. And honest risk verdict, if I wanted to tell, um, then it will be like riskier than FD means yes. Riskier than stocks? No. Because REITs are generally less volatile than equities, and safe for long term investors means it is yes. Because with a minimum 3 to 5 year minimum horizon, REIT risk is very manageable, safe for short term. If you ask, say for short term means no, because market price fluctuations can give negative returns in under 1 year. Now, coming to taxation, taxation is the most important chapter because pay close attention here. So this is the section most people skip and then file their ITR incorrectly. REIT taxation is unique. It is not the same as stocks or mutual funds. REIT distributions arrive in four components, and each one is taxed differently. Component 1 is dividend. If underlying SPV, that is special purpose vehicle, has opted for the concessional corporate tax regime under Section 115 BAA, dividend is taxable at your income tax slab rate. If the SPV has not opted for this regime, dividend can be exempt from tax. TDS, 10% of dividend exceeds uh, rupees 10,000 per year, financial year 2025 to 2026 threshold. Then component 2 is interest income, always taxable at your applicable income tax slab rate. TDS is 10% if interest income exceeds from rupees 10,000 per year. Component 3 is the rental income. So it is taxable at your applicable income tax slab rate. And component 4 is return of principal, that is debt or repayment. Not directly, but not directly taxable as income, but it reduces your cost of acquisition, which means higher capital gains when you eventually sell. The capital gains, if you see, will be less than 12 months. The tax type will be STCG and tax rate will be 20%. If it is a holding period is more than 12 months, then it will be LTCG, that is 12.5% on gains above rupees 1.25 lakh per year. So key 2025 tax update is very important, that is before budget 2025, LTCG on REIT units was taxed at the maximum marginal rate, which could go up to 30% from financial year 2025 to 26. And LTCG on REITs is now taxed at the beneficial flat rate of just 12.5%. This is massive improvement for long-term REIT investors. And practical tax example being, let's say you receive a quarterly distribution of 12,000. Okay. So if you like let's say you um, keep 6,000 as dividend, that is potentially exempt or slab rate depending on SPV, 4,000 as interest income, that is taxable at your slab rate, and 2,000 as return of principle that is not taxable but reduces cost base. If the dividend is exempt, you you only report 4,000 under income from other sources in your ITR. ITR filing: if you have any REIT income, dividend, interest, rent, or capital gains, you must file ITR 2, not ITR 1. Final tax takeaway is: hold REIT units for more than 1 year. Pay only 12.5% LTCG. Very reasonable. Short term trading will pay give you like 20% STCG. And please avoid this if possible, and always consult a CA because the dividend taxability depends on specific SPV structure of each REIT. Now let us come to um, capital gains and when you should how to buy REITs and step by step process. So if you like see how to buy REITs, then buying REITs is exactly like buying a stock, and here is complete process. Step 1 is open a demat account. You need a demat account to invest in REITs. So best platforms in India are Zerodha, the Kite, Zerodha Kite. So most popular, lowest brokerage, rupees 20 flat per trade. And if you take Grow, it is most beginner friendly interface. Upstocks is fast and clean UI. Angel One, full service with research support. And ICICI Direct or HDFC Securities is for bank integrated investing. So the documents needed are PAN card plus Aadhaar plus bank account. Time to open is 15 to 20 minutes online and free on most platforms. Step 2 is search for REIT. Open Zerodha on or Grow. In the search bar, type Embassy or Mindspace or BIRET or NXST. The REIT will appear exactly like any stock. Step 3 is place a buy order. Enter the number of units you want to buy. Market order. Purchase at the current market price, instantly executed. And limit order. Set your desired price and orders executes automatically when that price is reached. Okay, next we have step 4, that is confirm the order. The order executes during market hours 9:15 a.m. to 3:30 p.m. weekends. So units appear in your demat account by next business day. T plus 1 settlement. Next, step 5 is receive quarterly distributions every 3 months. Distribution is credited automatically to your registered bank account. No action required. Fully automatic. Charges overview. Brokerage rupees 20 flat per trade on Zerodha is very low. STT security taxation tax is applicable same as stocks. GST on brokerage is applicable, and entry level no entry level load or exit load unlike mutual funds. Now coming to how to sell or redeem REITs is selling REITs in the area where they completely dominate physical real estate. That is step 1, open your trading app, go to portfolio. Step 2, tap on REIT you want to sell. Step 3, click sell. And step 4, enter the number of units to sell. Step 5, check the current market price, place the order. And step 6, money credited to your bank account within 1 to 2 business days. T plus 1 settlement. And no exit load, no lock-in period, no penalties, no waiting. This is the single biggest advantage of REITs over physical real estate. Total and instant liquidity. Important is check whether the current market price is favorable before selling. Never panic or sell on market dips. REITs are long-term assets and short-term fluctuations are normal. Now let us see the investment strategy. Okay, so let's look at practical strategies for different types of investors. For beginners, first time investor, 5,000 to 25,000 per month investable surplus. So REIT allocation to be 10 to 15% of overall portfolio. And where to start is Embassy because most stable, or Nexus because lowest unit price. Amount begin with 5,000 to 15,000, and approach should be add a fixed amount every month and manual SIP style. For intermediate investors, I will be suggesting to who are like already in stocks or mutual funds, REIT allocation should be 15 to 20% of overall portfolio, where divide across Embassy plus Mindspace plus Nexus in three-way diversification. Focus total return yield plus appreciation, not just distribution yield. For income seekers, that is retirees or near retirement ones, REIT allocation should be 25 to 35% of overall portfolio, where Brookfield, that is highest yield, plus Embassy, that is most stable, um, you need to invest. And the goal is here is to use quarterly distributions to cover part of monthly living expenses. For aggressive growth investors, REIT allocation should be only 10 to 12%. Keep the bulk of capital in equities and use REITs purely for portfolio diversification and income stability. Investment horizon should be minimum 3 years ideal. 5 to 7 plus years REITs compound significantly over time, and patience is the most important strategy. Now let us come to the comparison section. Okay, so if we compare it, um, let's now compare REITs against every other common investment option. So if we take minimum investment in REIT is 130 plus, whereas in FD it is 1000 plus, gold it is 5000 plus, and direct property is 50 lakh plus, and equity is 500 plus. If you take regular income in REITs, it is quarterly, FD it is monthly, gold none, direct property monthly rent, and equity usually none. And if you take liquidity, REIT has instant liquidity, FD has penalty, gold has moderate, direct property has no liquidity, 6 plus months I think will happen, and equity mutual funds also is instant. If you take it, compare it again capital growth, then for REIT it is moderate, FD none, gold moderate, um, direct property is high but very slow, and equities are high. And if you say management, then REIT has professional, FD has nothing, gold has nothing, direct property you manage because it is nothing, um, you should only manage it, and equity has professional again. So tax efficiency in REIT it is complex, FD it is slab rate, gold it is LTCG, and direct uh, property it is complex, and equity it is better post 1 year. Inflation on hedge is in REIT it is yes, FD it is no, often negative real, and gold it is yes, you have inflation on hedge, direct property also yes, and equity is also yes. Risk level in REITs is low to medium, FD is very low, gold is low to medium, uh, direct property is medium to high, and equity is also medium to high. And regulation, if you say, REITs are regulated by SEBI, FDs are by RBI, gold is by moderate, and regulation of direct properties is complex, and equity is also SEBI regulated. So the verdict which I give is REITs give better returns than FDs with income, and REITs are very less volatile than equities. REITs are infinitely more liquid than physical property, and REITs beat gold because gold gives zero regular income. Ideal balanced portfolio is equity mutual funds 50% plus REITs 15 to 20%, gold 10%, and plus FD or debt 20 to 25%. Now let us see the current affairs. Okay, so or market connection. So now let's understand why 2026 is actually one of the best times to start investing in Indian REITs. Reason one being RBI rate cutting cycle. India is currently in an interest rate cutting cycle in 2025 to 26. When rates fall, and two direct benefits for REITs is REIT borrowing costs reduce, more income available to distribute, and second being that REIT yield becomes more attractive relative to falling FD rates. This is textbook ideal timing to enter REITs. And reason two being that office Indians or India's office space absorption at record highs. Bangalore, Hyderabad, Mumbai, and Pune are seeing record commercial office absorption, and major IT companies are expanding, non contracting, and their office footprints. Embassy and Mindspace properties have tenants logged in with multi-year leases. Now we have reason three being India's retail and consumption boom. Post COVID, mall football has not just recovered, it has surpassed pre-COVID levels. Nexus Select Trusts malls are running at 95 to 97% occupancy. India's young aspirational middle class is driving this consumption boom, and it's only accelerating. Reason 4 being growing institutional interest. Foreign institutional investors, insurance companies, and pension funds are all increasing their REIT allocations in India. And when institutions come in, credibility, price stability, and long term confidence increase. Reason 5 being SEBI and government support. Minimum investment reduced to one unit, accessible to every retail investor. Budget 2025 improved LTCG taxation, that is post tax returns better than ever, and the Indian government actively wants the REIT market to grow to regulatory environment is favorable. So reason 6 being that market is still like market is still early stage. So India's REIT market is at approximately billion dollar 18 billion gross asset value today, and only about 23% of REIT eligible office stock is currently part of REIT portfolios. So the runaway for expansion is enormous, and early investors benefit the most as the market matures. Now coming to final verdict or the final summary is that let's do a quick recap of everything important. So what is a REIT? It's a SEBI regulated investment in commercial real estate, co-ownership of premium properties starting from rupees 300. Returns is 6 to 8% quarterly distribution plus 4 to 12% capital appreciation is equal to 10 to 20% potential total return. Third one is best REITs in India 2026. Our Embassy for beginners and stability seekers, Mindspace, and growth plus stability analysts top pick Brookfield, and highest distribution is yield is Nexus Select, which is India retail or consumption play. Next point is that how much to invest is 10 to 20% of your portfolio. Start from 5,000, add monthly. Risk level being low to medium, riskier than FD, less risky than stocks, long term horizon recommended. Taxation being LTCG 12%, 12.5% if held over 1 year, STCG 20% if sold under 1 year, and income components at slab rate file ITR 2. And how to buy or sell is Zerodha or Grow. Exactly like buying a stock, T plus 1 settlement, no lock in, no exit load. Why to invest now is that rate cutting cycle plus record office absorption plus retail boom plus early stage market plus SEBI support is equal to perfect entry window. Final thought is that real estate has always been the most trusted form of wealth creation in India. REITs are the democratized version of that wealth creation, made accessible for every individual investor, and you don't need crores. You don't need a bank loan, you don't need a broker, just start today. And finally, the call to action being, if you learned even one new thing from today's video, do one thing right now. Hit that like button. Seriously, one click makes a huge difference to this channel. And then drop a comment below saying, I'm investing in REITs. If you have made up your mind or still researching which REIT should I start with, if you want a recommendation, I read and reply to every single comment, and hit subscribe and the bell icon, because every week this channel puts out detailed, honest finance guides exactly like this one. And share this video with one friend who keeps talking about investing in property but can't afford to. You might just change the way they think about wealth. See you in next video. Take care. Thank you. Bye bye.